For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. At the close of last month, the Chinese startup DeepSeek shook up the artificial intelligence sector after unveiling its latest AI model. Reports suggest that this new model outperformed its American counterparts while being developed at a significantly lower cost. Despite the market turbulence that followed, Cathie Wood, the chief executive officer of ARK remained optimistic. She emphasized in an interview with Bloomberg TV that reducing costs benefits the global market, adding that AI stocks were already under pressure, and DeepSeek merely accelerated the trend. Wood has built a reputation as a bold investor, willing to take unconventional risks. She was among the early advocates for Tesla and Bitcoin, often going against prevailing market sentiment. Her latest investment decisions reflect that same contrarian approach. Two well-known artificial intelligence stocks, Palantir and Advanced Micro Devices, have experienced very different trajectories. Palantir has emerged as a standout in the AI space, whereas Advanced Micro Devices has struggled to capitalize on the momentum. Given this backdrop, Wood's recent portfolio adjustments may come as a surprise. Let's examine her recent moves and leverage insights from tip ranks to see whether analysts on Wall Street support her latest strategy. The first AI-related company under review is Palantir, a firm specializing in data analytics and software. It provides solutions for government agencies, financial firms, and large corporations, leveraging its expertise in handling vast amounts of information. Established in 2003, the company initially focused on counterterrorism and intelligence work, collaborating closely with United States government agencies. Over time, it expanded its reach into the commercial sector, assisting businesses in optimizing operations, managing risk, and improving decision-making through data-driven tools. Palantir's transformation into an artificial intelligence powerhouse has been instrumental in its recent success. The firm has embedded AI-driven capabilities into its software to enhance automation and data analysis. At the core of this initiative is the artificial intelligence platform, introduced in April 2023, which enables organizations to implement AI models while maintaining security, transparency, and control over their data. This AI-focused approach has yielded strong financial results. In its most recent earnings report, Palantir's revenue climbed by 36% year over year, reaching $827.52 million, exceeding Wall Street's forecast by $46.28 million. The company's growth was fueled by a 64% year-over-year increase in revenue from commercial customers in the United States, which reached $214 million, while revenue from United States government contracts surged by 45% to $343 million. On the profitability front, adjusted earnings per share stood at 14 cents, surpassing expectations by 3 cents. Additionally, Palantir issued a strong outlook, forecasting revenue between $858 million and $862 million for quarter one, well ahead of analysts' consensus estimate of $799 million. Following these impressive earnings, Palantir stock experienced a sharp increase, a trend that has been consistent over the past year. Over this period, the company's share price has skyrocketed by an astonishing 409%. Perhaps sensing an opportunity to take profits, Wood reduced her position in the company during quarter four, selling 3,224,588 shares, a reduction of 30%. However, ARK still holds nearly 7.8 million shares, a stake valued at over $971 million. Some analysts have expressed concerns about Palantir's high valuation, a sentiment echoed by Brent Thill, an analyst at Jefferies. While acknowledging the company's impressive quarter four performance, Thill argues that this does not necessarily make the stock an attractive investment at its current price. Palantir delivered exceptional results in quarter four, exceeding revenue projections and demonstrating accelerated growth across key financial metrics. The firm achieved a combined revenue growth rate and operating margin of 81%, highlighting its strong fundamentals. However, looking ahead to calendar year 2025, revenue is projected to grow by 31% compared to 29% in calendar year 2024. Thill suggests that for Palantir stock to justify its current valuation, the company would need to sustain a 50% compound annual growth rate over the next 4 years, while trading at 18 times its estimated revenue for calendar year 2028. Even if it meets these ambitious targets, Palantir would still be among the most highly valued software companies in the market. Based on this assessment, Thill assigns an underperform rating to the stock, equivalent to a sell recommendation, with a price target of $60, implying a potential decline of approximately 52% over the next year. The consensus view among analysts is similarly cautious, with an average price target of $88.60, suggesting a possible 29% drop in share value. Overall, the stock holds holds a neutral rating, with 10 analysts recommending hold, 5 advising sell, and only 2 giving a buy rating. Palantir has built its success on capitalizing on the surge in artificial intelligence, but semiconductor powerhouse Advanced Micro Devices has experienced a much more challenging path. While shares of Palantir have soared, AMD's stock has struggled to reflect any AI-related momentum, instead declining by 32% over the past year. This outcome has been unexpected, especially since AMD was previously regarded as the primary competitor to Nvidia in the AI chip sector. Although the expectation was never for AMD to dethrone Nvidia, many believed the company under the leadership of Lisa Su would gradually chip away at Nvidia's market dominance. So far, however, AMD has not made significant progress in this regard. Despite this, the company has consistently delivered strong quarterly performances. This trend continued with the latest Q4 earnings report. The financial results revealed that the personal computer division performed exceptionally well, overall revenue surpassed projections, and adjusted earnings per share aligned with expectations. Additionally, AMD's revenue outlook for Q1 exceeded Wall Street's estimates. However, investors remained unimpressed due to a critical issue. Although the data center division, which houses AI processors, recorded a substantial 69% year-over-year increase in revenue, this marked a slowdown compared to the 122% growth seen in Q3 and failed to meet the projected $4,140 million. Furthermore, AMD did not provide full-year guidance for AI graphics processing unit sales, instead predicting a flat performance for the first half of 2025. The company anticipates stronger growth in the latter half of the year, driven by the introduction of the MI350 GPU. Investment manager Cathie Wood appears optimistic that AMD will eventually recover, viewing the stock's recent weakness as a buying opportunity, increasing her stake in the company by 54%. ARK Invest now holds more than 1,200,000 shares, collectively valued at over $137 million. Additionally, AMD has garnered support from Loop Capital analyst Gary Mobley. He predicts that by 2028, AMD will secure an additional 10 percentage points of the market share for x86 central processing units from Intel in both personal computers and general-purpose servers. He also anticipates that processors based on the ARM architecture will capture market share from x86 chips, but at a slower rate than expected, potentially reaching a mid-teen percentage by 2028. Mobley further expects AMD to claim 20% of the data center GPU market within the next few years. Additionally, he projects that custom AI application-specific integrated circuits will account for only 15 to 20% of the accelerated computing segment in data centers. Furthermore, he foresees AMD's field programmable gate arrays and gaming divisions entering a strong growth cycle by 2028. According to Mobley, the most critical factor in these predictions is AMD's ability to gain market share in the data center GPU sector. Should the company secure 20% of this market, it could contribute an additional $15 billion to $20 billion in revenue between 2024 and 2028. Based on these projections, he estimates that AMD's revenue could reach between $55 billion and $60 billion by 2028, with a gross margin in the high 50% range. This would translate to non-generally accepted accounting principles earnings per share between $11 and $11.50 by 2028. These optimistic forecasts support Mobley's recommendation to buy AMD stock, with his price target set at $175, indicating an expected 53% increase in share value over the coming months. Overall, 24 other analysts share his bullish stance, while 11 have issued a hold rating and 1 has suggested selling the stock. With an average price target of $147.88, AMD shares are projected to trade at a 29% premium within the next year. To summarize, AMD has faced difficulties in translating AI advancements into stock price gains, despite consistent financial strength. However, key investors and analysts remain optimistic about the company's long-term prospects. If AMD successfully captures more market share in these areas, substantial revenue growth could follow. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.